Yeah. So you often describe investing as a game of chess, anticipating, positioning, and executing with precision.
There's two things that chess kind of teaches you. One of the most important lesson is continuous learning. So how do chess players get better at chess? Is they analyze their own games after the games and study how they thought during the game and what should have been a better move or better strategy. The same approach applies to investing. It's to the point I'm writing a book right now exactly on this topic. So in investing, I'm studying Howard Marks, I'm studying Warren Buffett, I'm studying Ray Dalio, I'm studying Sam Zell, famous real estate investor. And the same approach applies. You basically continuously look at what you've done and how to get better. And in chess, the other component of it, it's a game of precision. In other words, theoretically, you can compute every possibility on the chessboard. Now, computers and AI can be today the world's strongest champions because their ability to compute is far greater than a human being. But the key message here is chess is an exact game. There is no element of a chance. Investing is a little different. There's a chance. You could make the right decision and the deal could still do poorly, or you could make a bad decision and the deal could do great. So what's important is the lesson is to make the right decisions.
Imagine building wealth in real estate without tenants, toilets, or taking 3 a.m. maintenance calls, guys. What if there was a smarter, data driven way to invest? One that lets your money work for you across dozens of properties, markets, and asset types, even while you sleep. Today, we're diving deep into the world with someone who's mastered it. Our guest is Big Mike Zlotnik, CEO of TF Management Group, a seasoned fund manager with over 2 decades of real estate investing experience from multifamily and self-storage to diversified income fund. Mike's built a career turning numbers into opportunities. He's also the host of the Big Mike Fund podcast, where he breaks down the complex world of investing into simple, actionable strategies. If you've ever wondered how the pros build true passive income through real estate funds, this episode is your masterclass. Hey, Mike, welcome to the podcast.
Lancelot, thank you kindly. Appreciate the opportunity to be here.
Mike, let's start with the moment everything changed. You had a successful IT career before making a massive leap into real estate investing. What was that aha moment that made you say it's time to shift gears?
It was essentially burnout of success. So I had a successful career. I was doing really well. My passion has always been real estate. I discovered real estate in 2000 passively. And in 2009, I was ready to go. My last gig was one company acquired another. I got my kind of exit package and I could go look for the next gig or I could go do real estate full time. And I was really happy to pursue my passion. And that transition in 2009 was just natural.
That's awesome, Mike. How did your background in math and systems thinking shape the way you manage funds today?
Yeah, so my background is really very helpful. It's that part of the brain that's all about numbers and very little kind of emotion. I'm stiff, although I can get a little bit passionate about real estate when I do what I love. You get a little more energy from me. But I am a chess master growing up in the former USSR, Republic of Moldova. Came here in '89, played a lot of chess, then continued my education was in math and computer science, and then I pursued the tech career. Long story short, it's all about predictability. Numbers speak. I love analytical and mathematical approach to underwriting deals, understanding the numbers. And there's still a lot more in deal understanding that goes beyond the math. But it starts with the math. You could look at the math and say, yeah, this looks like on paper like a great deal. Now let's take it to the next level.
Yeah. So you often describe investing as a game of chess, anticipating, positioning, and executing with precision. Can you expand on that mindset?
Sure. So there's two things that chess kind of teaches you. One of the most important lesson is continuous learning. So I can't say enough about this. So how do chess players get better at chess? Is they analyze their own games after the games and study how they thought during the game and what should have been a better move or better strategy. The other thing that they do is they analyze games of masters and grandmasters and world champions, and they study and they learn from the best. The same approach applies to investing. It's to the point I'm writing a book right now exactly on this topic. So in investing, I'm studying Howard Marks, I'm studying Warren Buffett, I'm studying Ray Dalio, I'm studying Sam Zell, famous real estate investor. And the same approach applies. You basically continuously look at what you've done and how to get better. And in chess, the other component of it, it's a game of precision. In other words, theoretically, you can compute every possibility on the chessboard. Now, computers and AI can beat today the world's strongest champions because their ability to compute is far greater than a human being. But the key message here is chess is an exact game. There is no element of a chance. Investing is a little different. There's a chance. You could make the right decision and the deal could still do poorly, or you could make a bad decision and the deal could do great. So what's important is the lesson is to make the right decisions. So when you make the right decision, the outcome could be good or bad. But if you make a lot of right decisions, then the outputs of the decisions on a statistical basis, on a long term basis, will work out. So it's all about the right decisions. And if you made the wrong decision and you can actually understand it, is to learn from your experience and get better with the next deal. So that's the best way to describe how chess can be applicable to investing in general and real estate specifically. What I love about real estate, and I'll shut up in a second, is that it's very predictable relative to the stock market. You can actually compute a lot of likely outcomes, and that's what I love about real estate.
Yeah, I like that too about it. Most people think real estate investing means buying a rental property, but you've built a model that lets investors participate in multiple deals without managing a single unit. What makes fund investing such a powerful alternative to traditional property ownership?
Sure. So in commercial real estate, there are two primary ways to invest, right? You invest either with partners or you can buy something direct. But buying direct, you need a lot of money. So when you invest with other folks, you invest either through a fund or a syndication. Syndication is typically the difference between fund and syndication is you have typically one asset, one property, commercial property. Could be multifamily, could be an industrial property, could be open air shopping, could be an office building. There are many types of commercial properties. But when you buy that, and there are investors, they're called limited partners, and then the operating partner is called general partner. You're investing with partners. When you do a fund, it's the same as a syndication. You have many investors, but you also have many investments. So the fund diversifies the investment pool of investor capital across multiple deals. So the beauty of funds is the fund level diversification. But compare that to a single family turnkey property or residential property, right? Typically, those acquired, you acquire it maybe with your spouse, maybe through an entity. You could have a partners too. You could acquire a portfolio of residential turnkey properties by yourself or with partners. There's neither right or wrong. But if you want to do it without tenants and toilets, you generally gravitate to selecting who you're going to invest with first, a fund manager or an operator in a given strategy, and look at their deals. You can, by the way, diversify in many ways. You could can write 10 different checks into 10 different commercial syndications, or you can write one check into a fund and the fund can diversify for you. There's no right or wrong. It's just different strokes for different folks. Some folks love to see every deal that they want to invest in, they want to understand, and they go with one of syndications. And then there's folks who just write the check and forget it. Then they can consider a fund.
Got you. For someone starting with, let's say, 50K or less, what's a realistic path into a diversified real estate fund?
Boy, 50K is, you could write a check into a diversified fund. You just got to figure out what do you like. There are many options, even in the fund space. You can do a private credit fund as an example. So private credit simply means a fund that loans money, like a hard money lending fund on fix and flip projects, which is one of the most common ways. You can do an industrial fund. You can do housing REIT. You can do a lot of things that are strategy specific. You can do diversified fund. You can write a fund check and the fund invest in 10 different strategies. So when you have a very small check, it's difficult to diversify directly or individually. Or you can just go pick one deal and you're not as diversified, but you're going to be able to underwrite deeper and better. You could say, listen, I'm happy with triple net industrial. I'm just going to write one check into one syndication, even though I'm concentrated here, but the deal is so conservative and defensive, you feel comfortable. So the most important thing, in my view, when you invest is actually the question that I'm going to ask next. Are you learning to invest or investing to learn? The reason it matters is because it's both. So when you are investing, you need to be learning from your experience. So when you write a check, you better be involved and understand what you're investing into, and then monitor how is it going, and continue to ask questions so you can get better at your decision making in the future. That's back to chess, lessons learned from your own experience.
Yeah, that is awesome analogy there. And when we talk about multifamily self-storage or alternative assets, what kind of returns or risk profiles are investors really looking at?
So this is a fundamental question, right? That there are different views on this, and I'm going to answer the question this way. Risk and reward changes with market cycles. So we just saw a market cycle reset when the Fed spiked the rates fast and furious and kept them higher for longer. So certain strategies and asset classes have responded to that way worse than others. So it depends on where you are in a cycle. There's certain investments that are more defensive at certain parts, at certain phase of the cycle, and some other ones are better when the cycle is at the bottom. So it's not a unilateral answer. It's more of a depends. So in general, kind of interesting conversation. We can talk about this deeply. So if you go on a risk profile, you go all the way from very speculative ground up projects. Anything ground up is high risk and your return profile better be very high. But again, high return target doesn't mean actual high return. It's because your risk has increased. When the market resets, real estate trades on leverage, the higher risk transactions could be losses, right? And then you have certain strategies that are a lot more defensive. So in general, I'll give you some examples. We find that one of the lowest risks in the real estate investing are absolute triple net industrial. They are very predictable. In some ways, they act and feel almost like primary debt. But if you look at the risk profile, primary debt at conservative LTV, it's supposed to be the lowest risk. With industrial, maybe some open air shopping following next. Again, it depends how you look at open air shopping. So industrial strategy as an example, it's typically long-term leases, very predictable, high credit quality tenants, very predictable income growth because of the rent escalation clauses. Absolute triple net means tenant pays for everything. But you're concentrated in one tenant. If that tenant has a problem, that's your risk. When you go open air shopping, you may have 5, 6, 7, 8 tenants in open air shopping plaza, but they're all Starbuckses and Targets. And so multifamily, interestingly enough, and storage, right? People used to think those are lower risk deals, but they responded really negatively when the market shifted. Why? Because operationally they're more difficult to run. As much as people say people need to live somewhere, the problem is during the COVID there were restrictions, collection issues, and it is an operating business. No matter what people tell you, it's a pure real estate. There are operating businesses in real estate, like senior living facilities, car washes, the multifamily. There are other parts of the operating part. So you just have to understand what you're comfortable with. And over time, we've gravitated more to, I would rather take more predictable commercial long-term leases. So industrial lease, 20, 25 years. Open air shopping lease could be 10, 15 years. Multifamily lease, 1 year typically. Self-storage lease, month to month. So if market conditions change, self-storage gets overbuilt, there are price wars, and suddenly your wonderful, great self-storage facility is now fighting with a newly built, refinanced facility, and the rates are going down heavily because it's month to month. The whole thing you could suffer quickly. So, if you think about why people go into real estate fundamentals, long-term leases, predictable tenants, in our book is the most conservative way to invest, and that's industrial open air shopping. You could certainly do multifamily today if you buy really deeply and right. Storage, it's a beast of its own. It's a recession-resistant asset class, which has seen some level of significant volatility due to the oversupply. So I would say there isn't one panacea, one solution that fits all. It's gotta learn enough so that you can start, you can write a check, but you gotta do it intelligently and understand risk reward in a market cycle. Right now, we are at a point where probably no matter what you do, you're gonna do well because the market reset. If you
If you
invested
start
in
now, you'll probably keep growing.
because the market reset, the interest rate
Yeah.
spiked, the market reset, the interest rate's now beginning to go down a little bit. So we are back into a recovery phase of the market cycle, in my view. We don't know exactly, it's not a crystal ball question, but it feels directionally we started recovery. And when you're buying into recovery, when the interest rates are high and the market prices are low, then over time, you will see meaningful upside when the interest rates come down. And the other thing that I really don't even care what happens with interest rates is you get into triple net industrial or open air shopping, a lot of these leases have annual rent escalation clauses. As long as the tenant continues to do well for long term, every year your NOI continues to grow, and so does your value.
That's a great way to invest. I always knew triple net was a good direction to go, but you get flooded in your everyday life, in your Facebook, in your Instagram, your TikTok, all these stuff. They flood you with the senior housing facilities, the self storage, the car washes. What's it called? The laundromats. Get one of those. Get one of
All
those.
operating businesses, all operating
Yes,
businesses, high
exactly.
risk.
And that's what my thought was too. Is like, hey, I want to invest and I want to be somewhat passive. I don't want to go in and revamp the business and get a better return and sell or whatever. That's not what I really want to do. Is I want to put my money somewhere where it makes me money without a lot of oversight. And that's what triple net is basically, because the tenant is reliable for the whole property basically. So you're bought the property, you own the property, they pay your rent and they pay the taxes, they pay the insurance, they pay the maintenance, they do their own build out. You don't have to do anything with it really. Just give them the keys and collect the money every month. Correct?
Yeah, it's got very limited property management and mostly asset management. You're managing a check that you wrote and you're collecting checks. That's asset management.
Yes.
You're reporting, it's a tax compliance, all that stuff, but that's where we gravitated to keeping our life simple. Lessons learned over time. Multifamily is, like you said, all these businesses, car washes, senior living facilities, even storage, the operating businesses at the end of the day.
Yeah.
And it's real estate with an operating business. So I just don't want to be. We do some of those deals. Don't get me the wrong way. We did a great deal earlier in 2025 on multifamily, 1,046 doors, because it was bought at such a steep discount from a heavily motivated seller. Then, yeah, we'll play in that space. But our partners have to be savvy operating partners running the asset because it's a lot of work operating a property like this.
Oh yeah. I have a small multi, so I know how much work goes into a small multi. I can imagine what goes into 1,000 doors. So
Yeah, it's economy of scale. You literally need to have the right size company that can operate that type of property. Your property manager, if they can't manage it, you could be a wonderful owner or you could be a distressed owner if the property manager can't operate. And what's crazy, alignment of interest is often different. So property manager, their job is to continue to manage the asset, but they have their very different interests. So what I do like when we do deals today, I want property manager to be a part partner. If they are
oh yeah.
part investor, part partner, and they have a vested interest and skin in the game, at least, that helps.
Because then it's not about I remember I had a property manager in my beginning of my multifamily career, and I always get the bill every month and clean up fee, this fee, that fee, blah blah blah. And I'm like, I'm not making any money at the end of the day because I'm paying this property manager her 10% plus all of these fees and then the mortgage. And I'm like, I made $100 this month. And I'm like, that's not good. And it was a lot of bogus fees because I went by the property and it was still full of trash. And I'm like, after I fired her and started self-managing the property and we went in and we cleaned up, it's been clean since. And I'm like, why did she charge me $150 every month for cleaning fees when there were bottles in the back of the yard and stuff like that? It's just like, what did you pick up? What did you clean up, really, at the end of the day?
It's misalignment of interest. At the end of
Yes,
the day,
exactly.
we see this all day long on almost any property. Many property management businesses, they're in the business of getting the contract and they have their own friendly plumbers and electricians and overbilling and overcharging. And this with all due respect. Maybe it feels this way on a lot of properties, but it happens. At the end of the day, you as the owner can't control exactly all these repairs.
Yeah,
And people in charge can overcharge for the work that's needed.
correct, correct. So you manage both equity and debt strategies. For the average investor, that can sound like another language. How do you decide when to lean into equity versus debt investing?
Sure. So it's interesting how people misunderstand. And today, a lot of deals from the last few years have had challenges. Again, multifamily, that as a strategy has been beaten up. Now, some of the great deals that are coming in today, in my view, if you can find a deep value deal, you're way better in equity because your risk reward is asymmetric with a greater upside in equity. And when the market reset, a lot of people went heavily into private credit. Just basically invest into something that's very defensive in nature, firstly lending, avoid the risk. And it's not a bad strategy. And we've done lending for a long time and we continue to do hard money lending today. So that strategy almost works through all cycles because it's a defensive strategy. But on the other side, when the market conditions change, shifting from debt, being a bond owner, basically into equity, could be beneficial because your upside is greater because you're buying deep. You'd be buying a deal when the market prices are low, and you're buying also a very motivated seller, distressed type of a deal. There's another angle to this. It also depends what kind of capital you're looking to invest. So if you're investing self-directed IRA money, in order to avoid, there's a funny tax. You hear this term, UBIT, unrelated business income tax. And what it really means is if you put your IRA money into equity of a deal with leverage, there's a thing called UDFI, unrelated debt finance income, or in other words, it falls under the UBIT. These fancy terms, but all it means, theoretically, if you invest IRA money into an equity investment, you could own some tax due to leverage on the money that you've earned. So if a leverage is 50% and you made $10 into your IRA, 50% of it is subject to that UBIT tax. On the other side, if you invest your money into a private lending fund, credit fund, interest income is exempt from UBIT. So again, it's a more suitable investment. It doesn't mean you should write a check only in debt with your IRA funds. You just got to be aware. On the other side, when you invest non-qualified funds, non-IRA funds, you invest cash in general. You're looking for cash flow, but you're also looking for tax efficiency. You're looking for tax benefits. So when you buy a commercial property and they run a cost segregation with 100% bonus depreciation that's been restored, you can get significant passive losses to offset your cash flows for years to come. So the beauty about investing in some of these commercial deals, you get the benefits of bonus depreciation through cost segregation, and you get your cash flow is shielded years out, and you can even use the passive losses to offset other things. So you got two considerations. You have IRA versus cash, you have risk tolerance, you have also your kind of upside versus risk approach. So there's no right or wrong. It's an individual decision, what is right for an individual set of circumstances, the bucket of money that they're using, and their own. There's another very important element of all these considerations. And you mentioned this. You said you're getting a bunch of emails from people with deals, from
Yeah.
strangers. I do that too. Guess what? I delete them as fast as I get them. If I don't have an idea who the jockey is, I don't want to even look at this. I don't want any cold marketing, period. We run funds. We're capital partners. What we do is we raise capital, we marry money and opportunity. So investors write us a check, and then we have deals that we write a check into. When we write a check, I need to know and trust who I'm investing with and have very high confidence in their ability to execute. So the idea is that when you are looking where to invest, you always start with who you're investing with. What's the organization? Who is the leader? Next, you go into what kind of deal. Now, if you're investing in a fund, then you're underwriting what the fund does and how it matches your goals. If you're doing a syndication, is what kind of a deal. There's a third element to this, and the third element is terms. So a lot of people don't even know this. We definitely do this, right? So we look at the deal and we're going to write a big check. We're going to step on operating partner, sponsors toe pretty hard. Here's a big check. We're giving $8 million check. We want these terms and we want following conditions negotiated. So the whole exercise is about who you're investing with, what kind of deal. You want a great deal, right? And then the terms. So when you're writing a small passive check, you may not be able to negotiate terms, but you're looking at the terms of the investment. And I'll just give you some example. I've seen people offer terms, will give you small preferred return like 7%, and then we keep the upside 50-50 split. We get 50% of the upside, you get 50% of the upside. To me, I call those terms a mom and pop terms. They're not institutional. What we often offer is 8% pref or 10% pref and an 80-20 split where investors get 80% of the upside. We get 20. So you got to go look through everything when you're investing. Are you getting a fair shake? Who's taking the risk and who's getting the upside if the deal does well? Does this make sense?
Oh yeah, it does. Totally. I love that thought pattern. I've done one syndication so far in my life, and I we went we didn't go south with it. We broke even on it because of what happened with the market. We bought the property March 1st of 2023, 3.5 million. We sold for 4.6 million, 2024, March 1st. We had it for one exact year. But
You bought post peak. So the peak was mid 22. And if you bought in 23, you were on the way down, but you probably didn't catch it at the bottom of the market. Maybe you did enough of the improvement. The fact that you broke even is actually not a bad outcome.
yeah, the syndication broke even. We didn't make any money off of it. The investors got their payouts. They all got their 10% payouts. So at the end of the day, you made the investors happy, but we didn't make any money, but we got a lot of experience out of it. And I think that's a win for me, win for a lot of the guys that were on the team. We had a lot of new guys on the team. So I think it was a big win in that perspective because I got to experience how this works, paperwork, et cetera, et cetera, et cetera. And
By the way,
I'm
don't be
comfortable doing it.
discouraged. Don't be discouraged by the fact that because you really didn't catch the bottom of the market. Now it feels like we're very close to the bottom of the market. I don't know exactly. I don't have a crystal ball.
Nobody
But
does.
at the same time, 23, we were still on the way down. The market did correct. At some point, I think we started bottoming out towards about a year ago, maybe. It's hard to say. It's really difficult to say. We know we are somewhere near the bottom, but the recovery may be slow. Unfortunately, I wish recovery was like a hockey stick. It's not. It's going to be slow for a while, and then it's almost like after the GFC, right? The Great Financial Crisis. Recovery took multiple years before things started really moving up.
Yeah. But then it started excelling fairly fast, which is good for us as a stock market. Hey, welcome to real estate.
Cycles exist everywhere. That's one
Yeah.
thing people don't understand. They think real estate is exempt. Real estate is actually not exempt. And because it trades on leverage, cycles matter even more.
Yeah.
And it's difficult to see a cycle. It's not easy to see. But if you can detect cycles and you can really sit on your hands and don't participate when the cycle is at the peak, and then re-enter the cycle when you're near the bottom, your returns going to be phenomenal,
Yeah.
astounding returns.
I mean, our area is, we still have a lot of stickler owners because they bought at the peak and they're like holding on the last grip of hope to get their 160, 170 a door. And guys, you are overpricing it because if you look at leverage, how much it costs to borrow the money that you borrowed in 2022 at 4 or 5% interest on this property, and now it's costing 6, 7% interest to buy that same asset. You guys are playing in a different ball game because the cost of the property, yes, you might have raised rents and all that stuff, but it doesn't really cover a good cash flow. So it's pointless for a lot of buyers to look at your property at that price point. And that's we're still at that phase where a lot of the owners are still holding on to, I want my 2022 numbers for my property. And they're just not letting go. They're not letting go. And you're like, you gotta let go at one point, man.
I'll give you the comment on this. So that is exactly the right point. The owners will hold on to dear life, and if they're able to keep the property afloat, you cannot convince them to walk away with a loss.
No,
This is not how it works. How it does work, where are you going to find opportunities to buy, deep value buy, is when they burn all that cash. They can't sustain the property any longer. It's to the point where the property is literally upside down. In other words, the bank's mortgage balance is greater than the property selling price. Then you can come in and you're really negotiating with the bank. And you could say the owners are not going to make a deal. What choice do they have? If they can't pay the mortgage, they're going to lose the property anyway. So when you approach a territory where the ownership survival is so thin that they can't bring any more money and they can't continue to pay the mortgage, this is where the pressure builds to the point where if there's a little bit of equity left, maybe they'll negotiate to walk away with something rather than nothing. And if you go past that, now you can even negotiate with a bank where a small haircut in this environment where banks are beginning to take a bunch of property back may be a viable option. You don't know whether they're going to extend and pretend. A lot of banks are also playing the extend and pretend game. So the play forward is kiss a lot of frogs to find the princess. It's always been the case. But you're going to find more princesses today than many years ago, number of years ago, because a lot of owners are stressed with the higher for longer interest rates and difficulty to manage these properties versus what, so again, seller and buyer, bid and ask, a pretty significant spread. And you don't need to go and try to negotiate with people who are not motivated. You have to find a motivated situation, and that's where you can find the deal. The moment it's not a motivated situation, I'll give you an example. We're looking at a deal right now. It's already a good price. They're all in for 25 million on a property. Now they can buy it for around 17. And the mortgage balance is right around 17, to make a long story short. One of the first questions I asked the partner who brought us the deal is the bank in default? No, they're still paying the mortgage. Aha. So the distress is not yet to the point where they can walk away from the deal and just clear their hands. You can get a better deal. Let them run out of money. Let them default to the bank, and then you can have a better conversation. As crazy as it sounds, and you really have to be not in a position of, I got to act, I got to do something. No, you got to be in a position, I'm only going to act if I find a great deal.
awesome. Yeah, that makes a lot of sense, my friend. So, what's the biggest misconception people have about risk in these types of investments that we previously
Wow.
talked about?
That's a great topic. So think of it this way. Most people perceive risk completely the opposite to the market cycle. This is how crazy it is.
Oh yeah.
Howard Marks is a great wizard of investing, and his investing is in stock market, but the concept applies. He says a couple of things. One, he says the higher the price, the higher the risk. All other things being equal. So when the stock prices are high, which is now, as an example, the market appears to be at the peak. It's got this irrational exuberance. It's got no fear at all. It's got all greed. AI is going to revolutionize the world. I agree. But at the same time, it feels like 1999.com. So the risk is perceived the lowest when the prices are the highest. Now, you could say these companies are making money left and right and earnings are growing. Of course, you adjust for earnings, but these PE ratios are at historic levels. Your cash flow distribution, S&P 500, your cash flow yield is like a 1.2, which is insanely low. So to make long story short, risk, perception of risk by the masses is often completely opposite of what it needs to be. When the prices are high, risk is actually the highest. When the prices are low, which is commercial real estate today, the risk is the lowest, but the fear is very high. So a lot of investors are shining away because, oh, we've lost so much money. I have money stuck in this deal or that deal. So it's the opposite, but that's a very important perception of risk. Risk is often difficult to understand. Actually, back to Howard Marks. He says sometimes before and sometimes even after you invest. This is the crazy part. Like in chess, when I play a game of chess, you can compute risk. Everything is finite. In investing in general, you can't. You don't know what happens. Sometimes you make a bad decision and the deal works out. Sometimes you make a great decision and the deal doesn't work out.
Yeah.
So it's a quality of decisions, and at the end of the day, you have to look at the market cycle. You have to see how downside protected I am today based on current level of risk, and then what is my upside and what happens under different stress conditions. And the world is not perfect. You could do your models until you turn blue. Give you an example. A lot of people did analysis of how far the Fed could push rates, and they look at the last 20 years, and the highest they've done is push the Fed funds rate to 2.5%, and they stopped. So they went from 0 to 2.5, and they stopped, and we never seen this 5.5% rate hike in the last 20 years. But sometimes deals go beyond the level of risk, and you don't even know exactly. But you do the best you can at the end of the day, and you diversify. You
Yeah.
just don't know what's going to succeed and what's going to fail. Diversify over many deals and diversify over time. The reason the diversification over time helps is because sometimes things go up, sometimes things go down. In stock market, it's called dollar cost averaging. In real estate, put some money today, you could put some money in a year, you could put some money in 2 years. And if you do it like that, you become more diversified over time as well.
Got you. So, given the current 2025 market environment, tight credit, fluctuating rates, how are you adjusting your fund strategy to these circumstances?
So we talked about some of these strategies already.
Yes.
Like today, we really love triple net industrial. We are very focused on getting into these incredibly downside protected deals because they are very conservative leverage, fixed rate debt. There's a very important underwriting. We look at actually three key elements of underwriting criteria today. One, I want to have positive spread between the cap rate, capitalization rate. So cap rate is simply, for those who don't know, it's the rate of return on your investment without any leverage. So if you buy a property for cash, just using an example, a house for 100K, and it gives you $6,000 net operating income after expenses, right? But before mortgage. This is your rent minus your operating expenses. That is the NOI. And you divide that six
$1,000.
by 100,000, and you wind up with 6% cap rate, capitalization rate. So what I want to see today is 2% positive spread between capitalization rate and a mortgage rate. So if we bought a property early in the year, 1,046 doors near Ann Arbor, Michigan, big property, multifamily, such a great price. We bought it at a 9% cap rate. We financed with 7% fixed rate mortgage, right? The mortgage was fixed for 3 years. It's a value add project, but you can do what is known as a rate swap. So you basically secure the rate for 3 years. So that's 2% positive spread. We just did a deal, open air shopping in San Diego. Great property, downtown San Diego, perfect location. 9.25 capitalization rate on purchase, 6.5 fixed rate debt, 10-year fixed. So when you have, that's a big margin of safety, that's downside protection. It's cash flow and downside protection. Two, I like to see today when you buy something, you get a steep discount to the reconstruction price. So people talk about building ground up, that's wonderful, but that's speculative. If I'm investing, I want to get a deal that is, let's call it 50% of the reconstruction price. Now you got to say, how are you going to do it? Distressed multifamily, you could find them. You can't find it everywhere, but you can find a steep discount of the reconstruction price. Of course, you have to adjust for the condition of the property. So depending on how much work it needs and the age of the property. But in general, that's another very important thesis. And then the third one is I want to see a discount from the peak of the market. So if something used to trade at a 125,000 a door, and in 22, today I want to get it for 80,000 a door. That's the 35% off, approximately. There's no right or wrong, but the range is 20 to 40% discount, especially multifamily. It's different in open air shopping and industrial. Those strategies held up way better, but they still have this. They have this in the industrial space. They trade on the 2% cap. They used to trade when the rates were low, and they trade today again on 2% positive spread. So you could finance at 4.5. The cap rate on a purchase was 6.5. Today, in industrial, I can get 8.5 cap rate and finance at 6.5. So what happens is when interest rates come down, that's massive tailwind because the cap rate, known as a compression, will significantly improve the value and the price. That's why we're shifting to equity investments, but with a lot of downside protection. That's the key shift that we're doing today. We will still do some hard money loans. We'll still do other strategies. We do it in open shopping. We do it in industrial. And we'll look at multifamily as an example. We love to do it in storage, but I can't find great deals of storage, and I don't like the operating part of the business. So we keep our eyes and ears open for the deep value deals that can have great downside protection without sacrificing the upside. And rule number one today, I will only do a deal with cash flow. No cash flow, no interest.
Oh, that makes a lot of sense. Are there specific sectors or regions right now that you think are undervalued or poised for a big gain?
It's difficult to say exactly. Depending on you could look at the Sun Belt, right? Some people have talked about Sun Belt. It corrected the most, but it got overbuilt the most. So they're talking about absorption of these assets, and it's a little more difficult. It's still more speculative. In theory, some of these assets that corrected so much, you could pick up a good deal. I prefer a little bit more Midwest with steady 80. So the correction has been still very significant, but you have a lot more stability of employment. And some people say, what do you mean? People are migrating south. Yes, they are, but at the same time, affordability is getting more difficult in the south, Florida, Texas, other parts, versus more affordability in some parts of the country like Midwest. So there's no right or wrong. We definitely want, if we go into some kind of multifamily housing, we want a market that is landlord friendly, right? I don't want to do multifamily deal in New York City where I live or in San Diego or California. However, we will do an open air shopping. We'll do an industrial deal because they're not subject to rent control laws. They're not subject to the difficulties that people would have with red state versus blue state, landlord friendly or tenant friendly type of laws. So it depends. And at the end of the day, when we write a check, our whole philosophy is who we invest with. So when I get a phone call from people we've done 8 deals in open air shopping and they tell me it's now San Diego, I don't go freak out. In fact, I say, that's wonderful. Are you getting a great deal? What kind of property is this? Where is it located? Who are the tenants? So the decisions are not necessarily based on where specific region of the country, but who we're working with and why they found a great deal. So who, then the deal, then you part of underwriting. Okay, what's the risk profile in this type of an asset in this type of a market? So it's not a specific region that I can be completely bullish on bearish. It's really all local.
Got you. So you managed through booms, recessions, and everything in between. What's one lesson from your 25-year career that you wish every investor understood?
So I cannot understate diversification. I really cannot. It's as basic as it goes. I can give you some fancy lesson, but most people where they go wrong is they don't diversify enough and they don't rebalance when something is up a lot versus when something is down. It's crazy, but I had a conversation with a great friend, the real estate guy like me, but here's a call that I got from him last December. And I didn't expect this conversation at all. It was like a shocking to me. He called me and he says, Mike, I got so much crypto. I can retire many times over. What do you got in real estate? So I said, his name is Jordan. He said, Jordan, I'm so happy you're reaching out because it's so hard for crypto guys. I don't know a lot of crypto guys. Stock market investors. The market is at the peak. They're doing so well. It's so hard to have this conversation, but you're thinking prudently. You've done really well. Diversify. Why? Because it doesn't hurt you to take some chips off the table and then put them into something that's significantly discounted. So he's written checks since multiple times, but selling that crypto to him was incredibly painful. He was like, I had to talk to him multiple times. Said, Jordan, you called me. I'm calling you back because you said you're gonna make the decision, and then you're sitting here and you're contemplating and discussing this. That's the nature of the beast. It's that complacency, and we're in a bull market until things really change. So the lesson learned is diversify. You gotta know, you gotta have some goals, and when something does incredibly well, don't be shy or scared to actually maintain your diversification. And The worst case scenario, you'll still do well. And here's what happens. If crypto goes to the moon, you sold 10% of your upside at 20% and you're still fine. If the crypto crashes and you move the money over, you're going to feel meaningfully better.
Oh yeah, for sure. And for someone listening who's ready to start building passive income through real estate funds, what's your one piece of advice to help them start today?
How would they say when you shoot a gun? I like to shoot guns. Can't do it in New York City, but when I go to
Come down to
Florida
Florida.
or Texas, yeah. So what do they teach you? Ready, aim, fire. What I would say, when you're starting, you got to go ready, fire, aim, and re-aim, and fire, and re-aim, and fire. You just got to act. Take action. Action is more important than perfection because you're taking action to learn from your experience, from your investing, and just continue your journey forward. It's more important to act than to look for perfection.
Awesome. You've got this incredible way of blending logic with vision, Mike. And I think that's why your message resonates with both data-driven investors and everyday people who just want financial freedom. If you're watching this on YouTube, don't forget to check the links below for Mike's free special report on passive real estate investing. You can grab it right now at tempofunding.com/special-report-2. It will be in the comment section underneath this. And make sure to subscribe for more conversations with the sharpest minds in real estate investing and wealth building. Mike, it's been an absolute pleasure having you on the Real Estate Roundtable. Your journey from tech entrepreneur to top-tier fund manager is proof that strategy, patience, and diversification can change the wealth game entirely. To our listeners, if you took value from today's episode, hit that like button, subscribe, and share this with someone who wants to earn smarter, not harder. Follow Mike, Big Mike Zlotnik, at Tempo Funding on YouTube and LinkedIn, and tune into the Big Mike Fund podcast for more deep dives into smart investing. Until next time, I'm Lancelot Lenard, reminding you, in real estate and life, timing and strategy are everything. Stay smart.
Let me chime in with one final comment. So I have a better place for people to go than tempofunding.com. That's a corporate website.
Okay.
The better place is bigmikefund.com. And if you misspell it, you forget the D at the end, you go to bigmikefund.com. I promise it's not a kinky site.
Thank you, Mike, for that correction. We'll put that in the description below as well. Stay smart, stay curious, and we'll see you at the next roundtable. Thank you, everybody, for tuning in. Bye.
Thank you.
Thank you for joining us on Sir Lancelot's Real Estate Roundtable, where we've unveiled the mysteries of real estate together. Remember, in this kingdom of possibilities, every dream home is just a discussion away. I can help your real estate dreams come true. Just call me at 786-449-7518. Until our next roundtable, may your ventures be prosperous and your homes be filled with love and joy. Farewell, fellow knights of real estate.